Hi and welcome to Demon Trades Trading Basics video 2. In this video I'm going to talk about trading terminology just to give you a better idea of words, phrases that are out there that you definitely need to be aware of as a trader. Okay, so let's start. Okay, so the first one is bid, and bid is the price the buyer pays to buy a stock per share in that stock. You'll find that on a lot of the broker sites if you're using an online platform or a phone platform, and that's essentially what it is. It's the price you pay for the stock, and that can vary slightly depending on the market makers, which I'll talk about later, in relation to the actual stock price to the price you pay. Next is the ask, and that is the price the seller gets for selling that stock. Okay, so there is the stock price and then there is the ask, which is always going to be a little bit lower, and that varies depending on the stock you're choosing. American stocks are though pretty good in terms of the spread between the ask and the stock price, and the same with the bid. Okay, so as I just mentioned, MMs, you might see that online if you're following certain people on Twitter accounts or you're just seeing something on Google. MMs are market makers, okay? So they're the ones who handle the trades of stocks. Essentially, they have the stocks on behalf of the company or the security that you're trading in, and they dictate the spread, okay? So they'll dictate that spread based on a number of things such as volume. Lower volume stocks might have a higher spread. So that's something to think about. They also have the ability, as horrible as it is to say, and whether or not people want to believe it, they can manipulate stocks, okay? So they might give a very bad selling price with the difference in the stock price and what they're prepared to sell it for, and very good buying prices. So if you're someone who's going to panic, you might see that the selling price, if you've got the stock, is really low, so you might want to get out because you're thinking, I'm losing money in my own account when you look at your account, but the stock's actually doing okay. So there are games that are played and things that are manipulated in the stock market, and you need to be aware of that. People might try and put fear into someone holding stock to sell, and then people will be buying it because the stock actually still looks quite good and moving on. And especially as a beginner, you need to be aware of this. You always need to look at the difference in the stock price and the buy and the sell, and then make a decision on whether or not you want to buy that stock or short that stock. I really can't stress enough that you need to really analyze that when you're going to buy any stock. So anyway, that's a market maker. Do they play games? I definitely think so. Plenty of others definitely think so. They'll deny it, but you never see any poor market makers. That's always something worth remembering. Okay, so we've already really mentioned spread. Just to recap, spread is the difference in what you pay for a share against its actual price in the stock market at any current time. It's almost always going to be higher. There may be some really good cases where it's the same as the stock price, and the same for selling. You know, you're not going to get the price of the share for selling. The market makers are the ones that make the deals happen, and that's their tariff, if you like. Okay, so that's what spread means, and always bear that in mind, obviously. Another one that comes up a lot when you're online is MOMO, and what MOMO means is momentum, and in trading that's a very important term. A momentum stock, it's building momentum, it's on the up. Okay, so if you're looking online and you've heard MOMO mentioned against a stock, have a look at it. Obviously confirm it, do your own research, but if you see those words, it's definitely worth researching, especially if it's from a reliable source. Okay, I love seeing those letters, to be honest with you, as a trader. MOMO, momentum, if it's just at the start of a momentum, there's a chance to make a lot of money. So I would definitely say that's an important trading terminology to remember. Okay, so now we've got RNS. The way that I get these in England is they're known as an RNS, which is a release of news. Most of the news is important. There is a lot of news out there that is not important. An RNS basically means there's been a release of news to the stock market, okay? So whether it's the New York Exchange, the London Exchange, the Dow Exchange, they'll be notified by the company of this news release. And some of the news releases are very important and they definitely dictate the movement of a stock. Other ones have no bearing at all on it, okay? And sometimes even news that you would expect to have an impact on a stock, sometimes it doesn't. So don't just think that news alone is going to make a stock move. That news needs to attract the right people to buy into that stock, and that's definitely something you need to think about. Okay, next one is bulls and bears. I'll do them together, the bulls and the bears. Okay, it's a very common term. If you don't know what it means, bulls refer to share price basically moving up. And what they'll say is because that share price is moving up, the bulls are in control. The bulls are pushing that share price up, okay, which then leads to a stock being called bullish. And for bears, it's the absolute reverse. Bears are pushing the stock down, right? So when the stock is falling, it's being pushed down by the bears and making that stock bearish, okay? So either the bulls will be in control or the bears will be in control unless the stock is just moving sideways, okay? Very important. So now we're on to sort of trading types here of going long and going short. You might hear it online or in a film or among other traders. Going long is when you're buying into a share, trying to make a profit by it rising in price, okay? So you've bought a share, and in order for you to make profit, you need the share price to go up. That's called going long. I'm going long on this stock or this security in the hope that it rises. And going short is the exact opposite. Going short is when it's quite complex, but basically you're buying a stock in the hope that it falls in price, and then you'll sell it and you'll make money on it falling, okay? That is what going short means. Okay, so now we've got volatility. Volatility is just when a stock is very buoyant. You know, 1 minute it's up $1, $2, $3, $4, $5. The next minute or 5 minutes it's down $3, and then it's up $4, and then it's down $8. That's a very volatile stock. You know, it's out of control. It's on an unknown path as such. Okay, so that's what volatility is relating to, which is pretty much self-explanatory. Okay, so now you've got sector. Sectors make up all the different divisions of the stocks in play. Okay, so all the technology stocks will be in one branch. So you might hear that technology is on the up, so you could have a look at all the technology stocks or securities and have a handful picked of those as your potential investment. And then you've got utilities, communications, healthcare, financial, energy. There's lots. Have a look online. But you know, you might find in the news that they're talking about certain sectors, and then it's always worth researching those sectors for good companies for an investment. Okay, stop loss. The most important thing for any trader, okay? The stop loss is the maximum you're prepared to lose on anything you're invested in, okay? So you bought some shares for $100 a share, and you don't want to lose more than $5 on each share if there's a traumatic event. So you would set your stop loss at $95, okay? And when it gets to that, below that point, your broker on your behalf will immediately try and sell your shares. Now you might not get $95 a share. It might have fallen so much, but as soon as they see the share price below that, they're going to do everything they can, in theory, to sell your shares, okay? So stop loss is very important, and it should be in every single trade you do, because you don't want it to end up at zero because of some catastrophic event, okay? The next one is averaging down. This is for a trader who really believes in a stock, but it's falling. So let's say that you buy a stock for $10 and the next day it's worth $9. You still think it's a good stock, but you want to bring your share price down. Now let's say that you can afford to buy as much at $9 as you did at $10. That means that now your overall shareholding price is $9.50. So if it goes back up to your original price of $10, you're actually making 50 cents a share. And then obviously you times that by how many shares you hold as to how much money you'll make. But you can carry on doing this. It's just a term. You can average down as much as you like. I have seen traders do it. Sometimes it works, sometimes it doesn't. It's something I have done, not often, but I have done it sometimes where I've missed the opportunity to sell it before the drop. I'm still happy that it's going to be a good investment, but it's even cheaper than it was before, so why not buy some more shares at a reduced price? It's definitely something to consider as a trader, not so much as a day trader, but I know that even as a day trader you do buy more stocks if it's falling on your initial prediction that the share price is still going to shoot up. Okay, dividends, I spoke about that in the last video. That's just certain stocks or securities will offer annual payout to its shareholders of a certain amount per share, and that's what that relates to. So if you're a long-term holder, a position trader, definitely have a look at that. It might sway you as to what security or stock you want to invest in. Okay, so the broker is the person or company who buys and sells shares on your behalf. Okay, so they have direct contact with those market makers. Okay, so MCAP is market capitalization, and that is the overall share value in a company. So that'll be the share price time the number of shares will decide the market cap. So it varies day to day, and it's basically a reflection of what investors feel that company is worth at any current moment in time, shall we say. Okay, so if you see MCAP, that is really the true valuation of that company as perceived by those invested in it. Okay, so the next one is portfolio. Portfolio is a selection of investments held by any investor or institution. So you might have a portfolio of 5 or 10 companies, and the portfolio just reflects the combination of all of your investments. Okay, portfolios can be very important. As I'd said before, if you're a swing trader, even if you're a position trader, it's better to not have all your eggs in one basket. You know, have 5 or 10 investments if you're a swing or long-term investor, so that you're always able to make good gains, because it's not like everything that you've invested in is going to go and shoot up the next day. But if you've got 5 or 10 investments, 1 or 2 or 3 might shoot up that week at a point where you want to take your profit out, and then the next week, and then the next week. So you've always got a nice steady flow of profit coming in. Not only is that good and smart for a trader to do, it also builds you with confidence that you're continually making the right decisions. If you've got all your eggs in one basket and it's having a bad day, a bad week, it can affect you mentally. So it's something to definitely bear in mind. Thank you for watching. Please hit the like button and feel free to subscribe to our channel.